Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about only investing in what you understand and why that can be a really good thing and why maybe some people would argue it's not the best thing to invest in things that you thoroughly understand. That is my viewpoint, and that's what I like to teach. But there are two sides to every coin, and I do want to teach you what other people think. I want you to have varying viewpoints to be able to make a decision for yourself as to how you will invest in specific things. But more than anything, I want to help you as individual investors, especially individuals who may not know much about investing. I want to help you to get into the investment world by understanding some basic things and understanding what you're investing in before you ever start investing in the first place. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that's specific to you and your family's needs and to keep you accountable to that plan over the long term, then I can help you do that. Just shoot me a message on Instagram, Twitter, Facebook, any of the social media sites, and let me know what you would like me to help you with, and I would be more than glad to sit down and have financial coaching sessions with you and help you to push on towards your long-term financial goals, and we can work towards getting there together. So on this show, one of the things that I'm trying to do is I'm trying to help you guys to learn as much as you can about the investing process and exactly how to go about investing your own money. Now, I'm obviously not trying to give you specific advice. I'm not trying to tell you exactly how you should invest your money. I'm trying to give you information, and you can use that information as you please. That's completely up to you. But one of the things that really eats at me, one of the things that really frustrates me when I see people go out and they start to quote unquote invest their money. Most of the time it's speculation, but they try to go out and invest their money, and they do so in things that they do not understand. And they go out and they're buying, Dogecoin, right? Which is not an investment at all, but it's gambling. It's straight up speculation. And they're going out and buying Dogecoin because they think it might get a pop, or, they hear that everybody buys Apple stock. So they go out and buy Apple stock at whatever price. Or they go out and buy Amazon or Netflix or one of the other large cap growth stocks that is very, very popular today. They'll go out and buy those and just expect them to go up in value. And luckily they have gone up in value over time, but why did you buy it in the first place, right? You don't just go out in your everyday life and buy things that you don't know what they are, right? You don't go to the store, right? Let's say you don't go to, Academy Sports, or you don't go to Dick's Sporting Goods or any sporting goods store and buy some good that is for a sport that you don't know what that sport is. That would be useless, right? Now, even though that thing may be useful in another context, and maybe you end up getting into that sport at some point, right? When you first bought it and you didn't understand it, it made no sense for you to purchase that thing at that time. And it's very much the same with your investments, right? When you are purchasing things, when you are investing in things that you don't understand, right? That's not to say that you won't understand them later, and it's not to say that they won't benefit you, right? It's not to say that they won't go up in value or provide you some income or do something for you, right? But if you don't understand them, you run a much larger risk than somebody who does understand what they're investing in as far as the returns that you'll make, because you are actually going to take on more risk, and you actually will have a lower expected rate of return, because when you don't understand something, you're far more likely to get rid of it at the first sign of trouble because you don't understand it and you get scared and you are like, oh my gosh, I don't know what's going on. Let me sell it as quick as I can so I can cut my losses, right? But somebody who understands something and it goes down in value, maybe they look and they go, oh, well, it went down in value. Maybe I'll buy more, right? Maybe I will just sit and let it come back up to the value that I think that it holds. Because just because something goes down in value doesn't mean that it will not come back up in value. And whatever value the market tells you something is worth is not always the value that it's worth, right? The market can overreact, the market can underreact, and we have to understand that as investors, and we have to make our investment decisions based on things that we do understand. Then we can make the best decisions possible, and we can be able to sit in an investment over a long period of time, be able to hold an investment a long time, be able to add more to that investment as it dips, and then make outsized returns to the upside over the long term. That is what you want to do with your investments. You don't want to jump into something and then at the first sign of trouble jump out. That's just not going to get you anywhere over the long term. You'll end up taking a lot of short-term losses and not a lot of long-term gains. And the things that you do make gains on, you also get out of those very quickly because you don't understand, whatever business or the mutual fund or the rental property. You don't understand what you're investing in, and so you're very likely to just sell and take your gains and go on about your life. And there's nothing wrong with cutting losses or taking gains, but if you do so in the name of I don't know what I'm invested in and I don't know what it's going to do next, so I'm scared, then you have the wrong approach to investing. And that's what I want to help you get out of. And I know a lot of you guys may be watching this and you don't know a whole lot about investing, right? Or you're just trying to get into investing, maybe in your 401k or your IRA or something like that. What I want to help you with is just basic understanding of what you could invest in, right? And then being able to do the proper research, understand what it is, and then start investing in a very real way, investing in a way that is going to maximize your money over the long term, and not just dipping a toe in here and then being scared and getting out and doing something else. No, I want you to really understand what you're going to invest in and then go very, very hard at that thing that you have high conviction about, and then you will make a lot of returns on the back end, very, very likely. That's typically how investing works. Now, where does this idea of investing in what you understand or what you know come from? Now, this is something that Peter Lynch taught, and when I went over some of the investing rules, investing principles that Peter Lynch taught, right, one of the things was invest in what you know. Right? He made a living on investing in things that he knew or that he understood. Now, Warren Buffett has also made a living on investing in things that he understood. And he calls this his circle of competence, right? He calls the circle of competence the circle in which he understands everything within that circle. He is competent in anything within that circle. And notice it's circle of competence, not circle of mastery or circle of genius. It's just a circle of competence, right? He is competent in these areas, meaning he knows enough to make a decision. Right? It's not a matter of knowing everything about an investment or everything about a business. It's a matter of knowing enough. It's about knowing enough to make a good decision and make yourself money over the long term, and know if a stock goes down, why that stock went down, or if a stock explodes upward, why the stock did that, or if the stock has a bad quarter, understanding what caused that bad quarter, right? It causes you to do some research and be competent in those areas of that particular company or that particular index fund or that particular mutual fund or whatever it may be. Now, just for example, when you talk about the circle of competence, right, an investor that has spent the last 10 years as a checker at a supermarket would have an advantage when analyzing the financial statements of a grocery store chain, right? They would be able to pinpoint the strengths and weaknesses of the business, evaluate the competitive climate of the industry, and compare the performance of the prospective investment against those of an excellent grocer. And they would be able to do that because they understand how the business works. They understand, what people buy. They understand how people make money, and understanding that consumer behavior, understanding how a business makes money is most of the battle when you're making your investment decisions. Now, the size of an investor's circle of competence isn't as important as clearly defining the borders. If you're unfamiliar with the insurance industry, don't even attempt to evaluate performance of a property and casualty company, right? If you don't know how insurance companies work, then don't worry about evaluating one, right? Because it's just going to take too much time, and it's going to take too much away from your ability to analyze other companies and make good investments. Likewise, if you don't understand the internet, don't bother ordering the annual report of an internet stock. Straying from the circle of competence leads a would-be investor into the land of speculation, and that is not where we want to be. We do not want to be speculators. We want to be investors. Now, I've told you before, it's okay to speculate a small portion of your portfolio, right? But overall, we should be long-term investors. And if we'll remember, the difference between investment and speculation is this, right? An investment should promise you adequate rate of returns and safety over time. So promise of safety and adequate returns over time. Okay. Now, the caveat to the definition of an investment is not just providing those two things, it's providing them upon thorough analysis. So an investment needs to be something that you can analyze, right? So upon thorough analysis, right, a promise of safety and adequate returns over the long term. And that definition comes from security analysis written by Ben Graham and David Dodd. Graham and Dodd being very moving figures in the life of the Oracle of Omaha himself, Warren Buffett, right? And then anything that does not meet this definition is speculation, right? So something that you cannot analyze would be something that you speculated in, or something that has no promise of safety would be speculation, or something that is not going to promise an adequate rate of return over time would not be an investment, it would be speculation, right? And so since we know this, then we can draw a line. We can draw a line as to what's investing and what is not, what's in our circle of competence, what's not, what we understand and what we do not. And the understanding comes by doing your homework and by doing the analysis and being around certain products and being around certain industries and understanding, just like that grocery checker that I was talking about just a moment ago, how that person understands the grocery business unlike other people. And so he or she has that circle of competence that others may not have. And everybody's circle of competence is different, right? We all have a different set of understandings about industries and investments and companies, but the key is to use that to your advantage. Now, how do you find companies that you understand? Well, you take a trip to your local mall, or you take a trip to the grocery store, or you take a trip to Walmart, or you take a trip to Home Depot, or whatever, right? And you look on the shelves, find things that you actually understand, find products that you buy. Think about things in your own home that you purchase. Think about things that are staples in your house, or things that maybe you really like and that you wear, or start thinking about those things first, and then really good investment ideas will come on the back of that, because you'll be able to go through a myriad of companies that you actually understand what they do in some way, shape, or form. Maybe just on a baseline level, but maybe you can learn really quickly what they do and move into a better understanding of what the investment offers, and then maybe the ability to make the investment over some time period, right? So see the things around you, look at the things around you, and see if there's anything of value there. And it's really funny. I do this quite often myself, and I'll just use the example of Berkshire Hathaway, right? Berkshire Hathaway is a conglomerate, right? And they own a lot of different businesses outright, and then they own pieces of a lot of other businesses as well. And so when I think about the fact that I own Berkshire Hathaway stock, I think about the companies that Berkshire Hathaway owns. So I think about Geico Insurance. Well, I use Geico Insurance. I think about Brooks running shoes. Well, I use Brooks running shoes. You drive down the interstate and sometimes you'll see a Clayton Homes, the manufactured homes, those on the side of the interstate. Those are Berkshire Hathaway, right? And then, the phone that you hold, right? The phone that's in your hand is likely an Apple iPhone. Well, Berkshire Hathaway owns a large percentage of Apple, or the computer that you're using. It's likely an Apple computer. So all these different things that fall under the umbrella of things that Berkshire Hathaway owns, and therefore things that they profit from, and then things that an investor can profit from. So I understand those businesses better. I understand Berkshire Hathaway better because I use a lot of their products. I use a lot of their services, and then I can look at a bunch of their other products and services and understand them pretty easily. And that's a big key to making a really good investment. Now, when you are investing in what you understand, you still need to understand that price matters, right? Price does matter. Now, you shouldn't just invest in something based on price, but you don't want to invest in something that you understand that is far too expensive, right? You want to invest in something that you understand that is below some measure of intrinsic value that you have determined, right? Now, this is when we're talking about individual stocks. For those of you out there who are like, I don't know what intrinsic value is, I don't want to try to find some value of something, I just want to invest. There's nothing wrong with dollar cost averaging, meaning putting a fixed dollar amount into some investment like an index fund or mutual fund, no matter the price, and just continuing to invest in it over time. That's perfectly fine. And a lot of the things that I've talked about are about individual stocks and individual companies, right? But I want you to understand what index funds are as well. I want you to understand what mutual funds are as well. I want you to understand that an index fund is a fund, right? Is a collection of monies from a bunch of investors that tracks this particular market index, and that market index being a group of stocks that are tracked over time based on either their price or their size, based on market capitalization or whatever it may be. And understand that at its baseline. Understand what kind of companies a mutual fund may hold. Understand the type of companies that an ETF or an index fund may hold. And then you can make better investment decisions on the back end. Because I see a lot of people, they'll be offered a 401k at work, and they don't know the first thing about making some type of investment decision based on that 401k. So typically they'll just leave it in whatever preset investment was set for them, right? Which is typically not the best thing that they could be doing for themselves, and it's typically not going to benefit them the most over the long term. But if they just simply understood some basic concepts about investments, about mutual funds, about index funds, then they could make better returns over time and be able to do so with the exact same 401k as somebody who just left it in, let's say, a 50-50 fund, a balanced fund, right? Or a target date fund that's not necessarily indicative of the risk that they are willing to take, right? It's problematic when you let other people make your investment choices without understanding what you're invested in, because you will almost always struggle to make returns. You will almost always not make the returns that you could have made had you just made some simple decisions for yourself. Okay, so that's what it means to invest in what you know. Now, how do we do this, right? How do we go about investing in what we know? Now, I talked about already looking at products and services, right? I think that's extremely important. Be aware of what's publicly traded and what's not, right? I would just implore you, go around your house, look at products that you like in your house, right? And type in the name of the company that made that product and just say, is this company a publicly traded company? And see if it is, and see what the stock is about and what the company's about, and look at their fundamentals and see if you can understand what that company does, and maybe that's an investment that you could make. But that's all you have to do. Walk around your house, look for different companies that make different products that you like, and just see, hey, what is this company? What does this company do? Is this company publicly traded? Can I invest in them at all? Right? So that's a place where you can start. Then, like I said with the grocery clerk, right? That individual, since they work in a particular industry, they understand that industry better. They have a circle of competence that includes that industry, right? So if you work in a certain industry, look around that industry, because you likely understand how people make money in that industry. And you also likely understand what constitutes a good business in that industry and what constitutes a bad business in that industry, right? And you'll be able to make better decisions based on that. Think about the competitors of the company that you work for, or think about the types of softwares that have to be used in your industry or hardware that has to be used in your industry, and think about who sells those. And you'll have a better understanding of how to make an investment based on what you understand. And then also, another way that you can go about doing this is with your hobbies and your interests, right? If there are things that you're particularly interested in that turn out to be publicly traded companies that do these types of things or provide these types of products or services or whatever, then that might be a particular investment that you could invest in. For instance, if you're really into cars, there are a bunch of publicly traded car manufacturers that you could understand better. If you do a lot of work with your hands, you build a lot of things, you like to do woodwork, whatever it may be, you could look into companies like Lowe's and Home Depot and companies that sell the products that you use in your hobby. If you're a big gym rat, right, there are a bunch of gym chains that are publicly traded, and you can look and, if you like any of those gyms, see what those companies are about. If you're a gamer, there's a lot of companies that make the games that you play, and so you can understand those businesses very well based on the sales of those games, how good those games actually are, how much better those games are getting over time, and whether or not you would continue to buy their products. You can make some really good and really informed investment decisions. But the key to all of this is not just understanding something. Yes, you have to understand, but you also have to do the research. You can never skip the research. You can never skip the analysis, because, again, an investment operation is one in which, upon thorough analysis, offers safety of principle and adequate returns, right? So we have to do that thorough analysis. We have to understand how a company has grown in the past. We have to understand how they're going to grow in the future, not just their sales, but also their earnings, where shareholder value is going to come from, if they're going to return value to shareholders via dividends or share repurchases or whatever it may be. We have to do that research, understand where your returns can come from, and then make a decision on the back end. And when it comes to investments that are not individual companies, individual stocks, when we're talking about funds, ETFs, mutual funds, things of the like, the research that you should be doing, you should be looking at expense ratios and saying, okay, what are the fees to this mutual fund, right? How often do they turn over their shares? Meaning how much buying and selling do they do within this mutual fund? Because the more buying and selling they do, the less tax efficient that mutual fund is going to be, and likely the less returns you are going to make over time. And obviously the higher the fees, whether it be 12B1 fees, front end loads, back end loads, whether it be your just basic expense ratio, the higher those fees are, the more costly that particular investment is going to be, and it's going to decrease your net returns. And that is why a lot of actively managed funds underperform, and why a lot of funds that have higher expenses tend to underperform over time, right? And so you need to be doing that type of research. You also need to be researching and going, well, what type of companies are held within this particular mutual fund? What does this mutual fund hold? Maybe it is not a stock mutual fund. Maybe it's a bond mutual fund, or maybe it's a balanced mutual fund where it holds stocks and bonds. What does it hold? What are its benchmarks? Is it beating its benchmark over time? Is it at least keeping up with a benchmark over time? These are all things that you can easily look into and be able to tell if one mutual fund or one ETF or one index fund is really good relative to the others. And then also look, is it actively managed or is it indexed? Because we've talked a lot about how active managers do underperform, and active managers don't quite make the returns because it is more costly what they do, and they get out of gains too early, and they cut their losses too early as well. Just like I said earlier, individual investors might try to do if they don't understand what they're investing in, and subsequently these particular portfolio managers are trying to make returns, and they're scared that people are going to leave, so they're trying to lock in returns that they can make at any point in time. So these are just basic things that you can do to understand what you're investing in better and make more informed decisions as to whether or not what you're investing in is proper, what you're investing in does provide value, and what you're investing in is going to provide you good returns over the long term. Now, that's all the argument for why you should buy what you know, why you should own what you understand, right? But there are also some that say, well, maybe you shouldn't buy investments that you know, right? Maybe you shouldn't just invest in things that you know. Now, I don't fully agree with this argument, but I do want you to hear it because there's a little bit of merit to it. But again, you're much likely to get burned if you don't invest in what you understand. So, first of all, it takes time to fully understand a company, right? Many new investors find it difficult to delve into the business models or 10K statements, meaning the annual reports of publicly traded companies for some obvious reasons, the most important being time and lack of knowledge, right? So not knowing exactly how to go about doing it. Now, not many of us can listen consistently to companies' earnings calls, and even if we could, we might not really appreciate what's being discussed. Truly understanding a company's balance sheet and overall financial direction requires specialized knowledge that most investors don't have. Now, though that is true, it is true that it takes some knowledge, it takes some learning and some understanding. If you just make sure that you gain that knowledge, you understand some of the basic things that can tell you where value comes from, you can still make good investment decisions. Now, even further, right? A pitfall in just investing in companies that you are comfortable with is the opportunity cost of not owning companies that are not yet well known, right? So if something's not yet well known, then you probably don't understand it very well, right? Most investors know that ExxonMobil sells gasoline and that Johnson & Johnson makes pharmaceuticals, right? And health and beauty products and things of the like. A valid argument can be made that these companies are predictable, right, and help mitigate risk in one's portfolio. However, the fact remains that the biggest gains from stocks typically come from companies that are earlier in their phases of growth, and they grow really fast, really early on in their life. And that is the truth. That does occur. But if you don't understand that company or what that company, I'm not saying you shouldn't invest in small companies. If you understand what a small company does and they're publicly traded and you can invest in them and you think it's a good investment over the long term, then by all means invest in it, right? But this is saying that you're going to miss out on fast rising companies. And yeah, you might miss out, but what does Warren Buffett say all the time? And it's proven true in his investing career. And I believe the exact same thing. There are no called strikes in investing, meaning you can let as many investments go by, as many companies go by as you want, right? And you're going to miss most good investments. That's just the nature of picking individual stocks. You're going to miss most of the good ones. But as long as you find one that is within your circle of competence, in your quote unquote strike zone, somewhere where you are really good at hitting that pitch, right? You're really good at making contact with whatever investment that is and turning it into good returns over time. As long as you can find that, that's all that matters. But there are no called strikes, meaning the ones that you miss, you're not held accountable for the ones that you miss. You're only held accountable for the ones that you swing out, for the ones you actually invest in. So I think that's very, very true. It is true that you're not going to get all of the fast growing, smaller companies when you are investing in only what you understand. But it is true that if you invest in what you understand, you're far less likely to get burned on something that is small and quote unquote fast growing if something that's small and fast growing actually flops. Okay. Now, another tenet of investing purists is the utmost importance placed on fundamental analysis, right? I said earlier, an investment, right, is upon thorough analysis. So this fundamental analysis, metrics such as price to earnings ratios, book value, price to earnings growth rates, free cash flow are just a few of the many data points used to determine if a stock is worth owning. Most of this analysis is based on the assumptions at least 1 year into the future. Using these metrics, fundamentalists and analysts try to peg a target price 1 year into the future. Instead of trying to figure out what all this jargon really means, why not look at a picture of what a company has actually done instead of what it is projected to do? A stock's chart tells you what it's valued at the moment you pull it up. Many stock technicians, those who focus on stock price intently, would probably agree with the old adage that a picture is truly worth 1,000 words. So this is saying that you can look at a chart and it can tell you a lot about a stock and how you should invest. And again, I don't necessarily believe this. Now, do I believe that there are technical patterns that should go along with your fundamental analysis to help get you the best price for a particular stock or buy or sell at the best price possible? Of course I do, right? But I still believe that fundamental analysis is all that matters, because a stock chart can look as good as you want it to look. But if the company is worthless, then the company is going to be worthless. And over the long term, the company is going to be worthless. And if I'm investing in something over a long period of time, I'm likely going to feel the fact that that thing becomes worthless, right? So even though you could invest in things that you don't understand, and even though it is tempting to invest in things that you don't understand, it's straight speculation if you don't understand it. Right? If you haven't done the analysis, if you don't know what you own, if you don't know what you're buying. And again, this is not about being a genius. It's not about being perfect at understanding exactly what's going on. It's about being competent. It's about having some level of competence to where you understand the business enough to make an informed decision on how you should invest your money. Or it's about understanding an index fund enough to make an informed decision, or a mutual fund or an ETF in order to make an informed decision. That's all it's about. I want you guys to make informed investing decisions and not allow somebody to make a decision for you, not make a decision without doing any type of analysis or any type of looking into something, and not making decisions based on the fact that somebody else said that it's a good decision to make. You need to make the decisions for yourself, and you need to do the analysis. And if you do, you're much more likely, if you do it in a rigorous way and you're very skilled in the way that you go about it, then you are far more likely to make money in the long term and make better returns than your counterparts who are basically investing with the crowd and not investing in what they understand, investing in what's hot at the time. And investing in what's hot could be profitable from time to time, but over the long term, if you know what you own and it has good fundamentals and you buy it at a good price, you will win with your investments. And that's just been proven. It's been proven time and time again by many of the greats and then many of the retail investors like you and I who've gone about this exact same trek into the investing world. So hopefully what I've helped you with today is understanding that if you know what you own, you can have better returns. If you know what you own, your investment life can turn out better over the long term. And if you don't know what you own, maybe you can make some short-term returns, but it does not mean anything over the long run because not knowing what you own can make you really uneasy and can turn you into a true speculator and gambler and not a long-term investor like we want to be. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of these platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just DM me or shoot me some message on Twitter, Instagram, Facebook, anything like that, and we can start working together via financial coaching sessions to build your long-term financial goals into a reality. So tune in tomorrow as I talk about moats in investing. And I think this is a very, very good idea for those of us who are trying to pick the best investments over the long term. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.